bags. Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly journalize depreciation as well as calculate book value. So if you're unfamiliar to those two concepts, don't fret gang. I dropped a link in a video that'll get you up to speed in no time. So with that being said, let's get it. So a quick recap on depreciation. Depreciation is actually a process in which we lower the value of long-term assets that we keep on the books longer than a year, throughout its life. Within this process, we know that we consider it an adjusted entry because it's done at the end of each accounting cycle or period. With this particular process, two things happen. First, an expense is created from the depreciation process called depreciation expense. Second, a contra account to whatever that particular long-term asset is being depreciated is also created, called accumulated depreciation. This contra account follows the initial cost of the asset itself on the balance sheet, thus helping it be reported at its appropriate book value. Book value just simply means the cost of the particular asset minus its accumulated depreciation. So as we come to realize, accumulated depreciation does just that. That particular contra account grows and grows each period after we make the proper depreciation adjustment, thus allowing us to report the effective book value. So as the assets get depreciated more throughout its useful life, the book value decreases. So let's take a look at all of this stuff. It says on October 1st, Orlando Gold Exchange paid cash $5,600 for computers that are expected to remain useful for 3 years. At the end of the 3 years, the value of the computers is expected to be zero. So a lot of stuff going on, gang. But what we need to understand is that when we compute depreciation, there are three major factors. One obviously being the cost. Two obviously being the useful life, how many years we expect to depreciate this asset. And last but not least, the residual or salvage value. Basically, the residual or salvage value simply means how much of the value of the asset will remain after it's fully depreciated. So within this particular problem, we have no salvage value. So what does that really tell us? We're going to depreciate this asset fully throughout the 3 years. So requirement 1 tells us to calculate the amount of depreciation for the month of October using the straight line depreciation method. Okay, so we have various different ways to calculate depreciation, gang, and we'll talk about those in later videos. But for right now, they want us to use the straight line, which is the easiest of them all. Straight line formula simply tells us that the cost minus the salvage value divided by the number of years will tell us how much to depreciate the asset on a per year basis. That amount will remain constant throughout its entire life. That's why they call it a straight line. So, for us to calculate depreciation expense for this particular period for the month of October, we first have to calculate depreciation expense for the entire year. So what we're going to do is take our cost of $57,600, subtract the residual value or the salvage value, which in this situation is zero. Then we're going to divide it into the 3 years. Once we do that, that'll give us our depreciation expense for the year. So our depreciation expense for each year will be $19,200. But remember, gang, we just need to calculate the depreciation expense for the month of October. And since there are 12 months in a year, we're going to take that $19,200 and divide it by 12, thus getting us the depreciation expense for the month of October of $1,600. But back to the problem, it tells us to begin by selecting the labels, then enter the amounts and compute the amount of depreciation for the month of October. So our formula is going to be cost minus residual value divided by useful life divided by 12 months. So we're going to check the answer. Bags all day. So now they want us to put the numbers in, gang, and we already know what to do.
Just do it!
Check the answer. Fantastic, gang. So now they want us to make the actual adjusted entry for depreciation. And as I mentioned earlier, we're going to debit depreciation expense and credit accumulated depreciation. So depreciation expense will be debited, increasing our expenses for the $1,600. And we're going to credit accumulated depreciation / computer for the $1,600 as well. And this is to record the depreciation on the equipment. Check the answer. Nice work, gang. Now we're instructed to post those transactions into the ledger. And we know how to do that, gang. We're simply going to take that information that we journalized and post it into the transaction as such. We're going to check the answer. Fantastic. Now they want us to calculate the book value that will be reported on the balance sheet. So in terms of this particular computer, we will always report it at its initial cost, but right directly under it, we're going to show the effect of its contra account called accumulated depreciation. So the computer is going to be reported at its initial cost of the $57,600, and we are going to subtract the accumulated depreciation balance, which we have to be $1,600. And that will give us a total book value of $56,000. We're going to check the answer. Bags all day. So there you have it, gang. A quick, easy illustration of how to properly adjust long-term assets through depreciation, as well as how it's being reported on the balance sheet. If that light bulb is clicking upstairs, please feel free to like, subscribe, and share the channel with your friends so they can chase the bag with this accounting information as well. As always, gang, I'm Dr. Who, and it's always my humble pleasure to have you guys here spend your time with me. See you soon. Bags!